Hello and welcome back to Digital Assets Daily. Good morning, good afternoon, or good evening, wherever you are in your corner of the world. Today I have a handful of information I want to get into. A lot of different discussions, updates that I feel are important to see what's going on in the entire space, just to see, or just to show all of the importance of where we are and how early we are, but it will start making a lot more sense. Again, for those of you who've been around a while, these are basic news updates, but for those of you who are new, you can see how early you are and how amazing this opportunity really is. All right, right off of the IMF blog, the central bank digital currencies, 4 questions and answers. I'm not going to go through the entirety of this, but I will go through a lot of it. The central bank digital currency, CBDC, is a complex and multidisciplinary topic requiring active analysis and debate. It raises questions related to monetary policy, central banking operations, and payment systems, as well as financial stability and legal foundations and regulation. Below are some of the most pressing questions and answers on the topic. The first question is, what is the IMF's role around CBDCs now and in the future? The IMF can help in 3 ways: by informing the policy debate, by convening relevant parties to discuss policy options, and by helping countries develop policies. Because CBDC is a novel topic, the IMF has mostly been active in the first 2 areas, but it is gradually moving into the 3rd area as member countries consider CBDC options and seek advice. First, the IMF can help inform the policy debate. The IMF is currently investigating implications of CBDC available across borders. Other institutions such as the Bank of International Settlements, also known as the BIS, and the Committee on Payments and Market Infrastructure, among others, have also contributed to the topic. The IMF is well placed to study CBDC because it can draw on its in-house experts. Moreover, the potential world with multiple CBDCs could raise important questions about cross-border payments and the international monetary system, which are the core of the IMF's mandate. And the BIS has stated that Cambodia has successfully used CBDCs, so I believe that's why the IMF is stating they're able to get their information directly from the BIS. Each country will have to weigh the pros and cons of the case for CBDC depending on its particular circumstances. Second, the IMF is well positioned to help foster cooperation across countries and relevant parties. The IMF can draw on its universal membership to share important information about rapidly evolving developments across advanced and emerging market economies. Moreover, because the IMF is a public international institution, it can bring together central bankers and regulators as well as investors, entrepreneurs, and academics from around the world for an open dialogue. It has done so repeatedly at its bi-yearly meetings, in its yearly FinTech Roundtable, and in its ad hoc research events. Third, the IMF can help countries evaluate policies regarding CBDC as well as investigate alternative means to improve payment systems. The IMF can do so through its surveillance work, its financial sector assessment programs, and its technical assistance, which it has a long tradition of providing. IMF teams have already worked with countries to modernize payment systems, advise on legislation related to digital payments, and review plans to issue CBDC. The IMF can help countries think through the implications of CBDC and its attendant potential benefits and risks, including through regional workshops leveraging knowledge in central banks at the frontier of CBDC development. and bilateral technical assistance missions. Second question, how does the IMF view global development and implementation of CBDC? Countries differ substantially in the extent to which they are actively exploring digital currencies and in their proximity to issuing such currencies. Some countries are actively running pilot projects to explore the feasibility of CBDC. To do so, they have increased resources allocated to CBDC and fintech research at the central bank. Sometimes in partnership with private sector advisors, several countries are also reviewing and revising legislation to support CBDC in case it were issued, and are actively studying the potential implications of completing CBDC designs. Some authorities are also engaging with the public and their legislatures to discuss the potential to issue CBDC. Some other countries have also scaled up resources dedicated to CBDC and payment systems, although they mostly focus on undertaking analysis and more limited hands-on testing of technology. Although CBDC remains an option for these countries, they are also actively exploring alternative solutions. A third set of countries do not see an immediate need to issue CBDC and focus instead on improving existing payment arrangements and strengthening regulation. Recently, we have seen an increase in central banks' interest in CBDC following the announcement by Facebook of its Libra initiative, as well as reports of a possible launch of CBDC by the People's Bank of China. The next question is, what are the potential benefits and challenges related to CBDC implementation? Central banks highlight a number of potential benefits of CBDC, and these include I'm going to go through the titles here, but not through the full detail. I'll allow you to do that on your own time if you're interested for the exact specifics, as the links will always be in the description below. That would include the cost of cash, financial inclusion, stability of the payment system, market contestability and discipline, countering new digital currencies, support distributed ledger technology, the DLT, and the monetary policy. Despite these potential benefits, various challenges could emerge. Some of these can be attenuated by the appropriate design of CBDC, and that would be the banking sector disintermediation, the run risk, the central bank balance sheet and credit allocation, the international implications, and the cost and risk to the central bank. In summary, each country would have to weigh the pros and cons of the case for CBDC depending on its particular circumstances. Countries may consider the option of public-private partnerships that may achieve many of the same benefits of CBDC while potentially reducing central bank involvement and operational risks. IMF staff have coined this solution the synthetic CBDC. More specifically, the synthetic CBDC model envisions private sector firms issuing digital coins to the public, which can either be accounts or tokens leveraging DLT. These firms would thus be responsible for doing what they do best, innovating and interfacing with customers. The central bank instead would provide trust to the system by requiring that coins be fully backed with central bank reserves and by supervising the coin issuers. This arrangement preserves the comparative advantage of each participant, whether it is a private sector firm or a central bank, and induces competition among private sector firms to offer attractive coins and interfaces. At the same time, it limits cost to the central bank as well as some of the risks. Final question is, what are the alternatives to CBDC? Several countries are working on improving existing payment systems to match the speed and convenience of digital currencies. For example, we understand from published sources that the Federal Reserve is developing so-called fast payments, allowing nearly instantaneous and low-cost settlement of interbank retail payments. The Federal Reserve's FedNow initiative, and we know as investors who had been working with them, to help this design, which would be Ripple, using their XRP. In other countries, similar systems have improved payment services and injected competition in payments, especially if paired with other reforms such as public digital identities, common communication standards, open application programming interfaces, the APIs which allow banking applications to interoperate and to be extended by third-party developers, and data portability and protection standards. While improved interbank payment systems will bring many of the potential benefits discussed above, the CBDC could be complementary, especially in some jurisdictions. Central banks have raised the following arguments. First, CBDC, or its synthetic version, can be DLT-based and thus potentially help to spur the development of DLT-based asset markets. Second, a CBDC can be designed to work outside the banking system and may thus favor financial inclusion. Third, the CBDC could provide competition to banks and induce these to fully leverage the advantages of fast payment systems. And fourth, the DLT-based CBDC could facilitate cross-border retail payments, thereby complementing the not-so-easy task of linking traditional interbank payment systems. We generally think that the central banks should remain engaged in examining the full range of issues associated with CBDC, including the potential to offer synthetic CBDC and deepen their familiarity with new technologies. And there's a lot that's interesting in this. A lot that could easily create a heated discussion between different communities when you hear the cross-border retail payments. It brings to mind only two that come to mind would be the XRP and XLM. I know a lot of people don't want to hear this, Stellar, but it is coming up everywhere. Not saying that it is, but saying when I hear the retail, those are the only two that come to mind on that issue. Also, we have the authors of New York's P2P public Venmo bill hope for greater decentralization. The New York lawmakers proposed a bill on a peer-to-peer, P2P, savings and payment platform called the New York Inclusive Value Ledger. Introduced by New York State Assembly legislator Ron Kim and Senator Julia Salazar, the bill proposes to set up the Empire State Inclusive Value Ledger Establishment and Administration Act that would create a system of wallets for payments by state entities and the residents. According to public records, the bill was proposed in the State Assembly and the State Senate on October 23, 2019. But New York State legislative session only reopened on Wednesday, January 8. I'm going to stop there just to get into the bill, but feel free to research that further if you're interested. Next headline from the Ottawa Bullion: Is this why central banks are rushing to buy gold? Gold has seen an impressive spike in price in the past 18 months. And if you're wondering what the cause is, you'll find almost everyone has a different theory. That said, certain factors in historic gold rallies tend to be ignored. For example, the mainstream financial media often hyper-focuses on stimulus measures by the Federal Reserve as the cause. But I would remind people that the most recent upward trend in gold started while the Fed was tightening liquidity and raising interest rates, not stimulating. Also, many analysts suggest that precious metals absorb investment cash flows when equities are sliding. Yet for now, stocks have been rallying for the past year as gold prices also trend upward. So what is the mainstream missing here? First and foremost, it's important to understand that gold is not necessarily just an inflation hedge. It is also a crises hedge. As economic and geopolitical uncertainty grows, gold prices skyrocket. The past decade has seen uncertainty and instability that the world has not seen for almost a century. The problem is the average American is oblivious to the state of affairs. They have no idea how bad the situation can get, as they assume there are checks and balances to counter any potential disaster in the financial structure. They assume that the government or the banks will step in. However, there are signals that tell us that this will not be the case. In fact, it appears that central banks around the world are preparing for an event that they either cannot quantify yet or simply refuse to warn the public about. This is evident in the acceleration in gold stockpiling by banking institutions. In 2018, foreign central banks bought levels of gold not seen since 2010. The past year of 2019, according to third quarter figures, shows that banks bought even more, 12% more than in 2018. Last year, central banks purchased at least 550 tons of the barbaric relic, and it looks like they don't plan to stop anytime soon. Leading buyers have included Russia, China, and Turkey, with former two being the leading buyers for several years now. But central banks aren't just buying gold, they are also demanding their gold storage be transferred away from the offshore holdings and back to their own vaults. Germany repatriated $31 billion, or 583 tons in gold from Paris and New York vaults. Turkey repatriated 220 tons from the Federal Reserve. The Netherlands repatriated 122 tons. Poland repatriated 100 tons of gold from vaults in England. Both Hungary and Romania have announced plans to get their gold holdings back. And nationalists in Italy have demanded that Italy's gold reserves be released by banks and returned to public control. The bottom line is there is a gold rush going on by central banks as well as governments, and the public is being left utterly out of the loop as to why. I would suggest that it's clear what's going on. They know what a global crisis is about to happen, and so they are preparing as any smart investor would by buying the one commodity that always goes up when the manure hits the fan, and most other assets go down. But what is the nature of the crises they are preparing for? Most likely a geopolitical conflagration, followed by a monetary crisis with the US dollar at the epicenter. Economic disasters do not generally happen in a vacuum. They are always geopolitical threats that trigger the collapse of financial bubbles, or the threats are engineered to coincide with the bubble collapse in order to obscure the true culprits behind it. One way or another, it would appear that the central banks are privy to a looming calamity that will result in a threat to the current monetary order. I suspect that this event will be preceded by a geopolitical conflict, a smokescreen or a scapegoat that will take the blame for the disaster while the central banks that created the mess in the first place escape scrutiny. And that's why a lot of people are starting to point at this current moment to the U.S. and Iran conflict that is happening at the moment. And another thing that I've wanted to bring this up, as you see the central banks are holding the gold, and in the first article that we started discussing, you had the central banks stating that they could use CBDCs if they backed it with the reserves in the central bank. And what are the central banks doing? They're stockpiling gold. So there you have it. They could have CBDCs, again, backed by gold. And a lot of people in the community get upset and frustrated and stressed out at the thought of backing, let's use, for example, XRP by gold. But if it's going to be into the central bank, it has to be backed by their reserves. And what are their reserves? They're starting to stockpile lots and lots of gold. Not saying that's exactly what's happening, but saying that is most likely what's going to happen is whatever CBDC they choose. If you don't like it being gold to XRP, what are you wanting it to be? Gold to XLM? Then you really don't have that investment. A lot of people are saying that XRP is in itself its own value. But again, everyone is comparing that to the speculative run that is Bitcoin, which everyone stating it is saying that it has no true accurate value on its own, as it's slow and can easily be replaced by either XRP or XLM. Either one of those basically have faster time and better security because there's less volatility in the time that it takes to transfer any kind of value. And those, in my opinion, being almost identical twins, except for one being for profit and the other being a non-profit. There's other detailed specifics, but those are really the major specifics. But the growing rift between the U.S. and other major trading partners, along with the increased danger of regional war with nations like Iran, are setting the stage for what I predict will end in the loss of the dollar's world reserve status. Some people might see this as a good thing, but such a reset would leave the American economy in shambles for decades to come, as our economy acclimates to losing the single thread that was holding our system together. Rebuilding the system without dependency on reserve status or centralization would be nice, but that can only happen if the central bankers are removed from the equation and true free markets and price discovery are allowed to flourish. As long as the banking elites remain in charge, our economy will never be healthy and will never recover from a major crash or monetary crises. Frankly, they don't want us to recover anyway. If central banks intended to save the current system, then they would tell the public why they have been stockpiling gold and what the specific threat is and what they are preparing for. They would be encouraging the public to buy gold and silver as well and find some financial independence and security. I am often asked why globalists and international banks would seek to deliberately hide or instigate a global economic crash. Wouldn't this threaten their base of power, the golden goose that they will use to exploit vast amounts of capital and the entire political systems? My answer is simple but historically correct. The banking elites need crises to consolidate power. They don't lose power or financial influence during a fiscal panic. They gain power and influence. With each passing financial demolition, the public loses more and more hard assets. These assets are gobbled up and devoured by financial institutions, not because they have much use for all that private property, but because they don't want you to have that private property. That is to say, the banks are machines designed to slowly or sometimes quickly siphon private property away from the public until private property is a memory. Once private property is gone, public survival depends on the charity of the state and its corporate partners. Without property, dependency metastasizes like a cancer. Property is protected by hedging capital into defensive commodities as well as by organized defiance of theft. During any major crises, there is always a window of time in which precious metals can be used to secure hard necessities while countering the loss of buying power common during inflation and stagflation. The longer you can remain solvent during a crisis, the more influence you will have over the course of events. The more dependent or desperate you are during a crisis, the less use you will be to anyone. The levels of central bank gold buying have increased so rapidly in the past 2 years. This suggests to me that whatever they are preparing for is about to occur very soon. With consumer and corporate debt at all-time highs, the recent liquidity crises and repo market loan response from the Fed, along with the highly volatile tensions between the U.S. and Iran, I seriously doubt we will make it through 2020 without a shock to the system. And as I was just stating, so do they here in this article. Certain central banks have been positioned to benefit. Others, like the Fed, are decidedly unprepared as there is not much concrete proof that our own gold reserves exist. Looking at the bigger picture, the shift in gold holdings around the world show us where the global elites plan to stash their cash while the U.S. takes a nosedive. These will be the regions most immune to a monetary wildfire, while price fluctuations are always rampant in times like this, as I noted in July of last year. The overall trend for precious metals will be up from here on. And unless you suddenly see central banks start dumping their gold reserves instead of buying hand over fist, then I suggest readers copy their strategy and get a stack of physical gold as well. The only difference that we are aware of that he isn't is in the digital assets. And I believe what we have, are digital gold. Another interesting thing, the Nets player on pace for January 13, Tokenized bond launch. Although I used to love basketball years ago, I don't watch as much as I used to. Spencer Dinwiddie of the NBA's Brooklyn Nets will launch his tokenized security offering on January 13 in collaboration with digital securities company Securitize. And Securitize is an exciting one there. After reportedly setting terms with the NBA, the Spencer Dinwiddie bond launches January 13th. Dinwiddie said in a January 10th tweet, adding, "I'll also be taking 8 fans to ASW with me." Securitize also showed its support of Dinwiddie with a January 10th tweet from its CEO, Carlos Domingo. Carlos Domingo tweeted, "At Securitize, we are extremely excited and proud of the digital transfer agent and technology partner for Dinwiddie and Dream Fan Shares, world's first professional athlete investment security token. Innovation takes courage. Kudos." And here you have, if you're more interested in the details of this, you have the months in the making and then the backlash from the NBA inside the article. A quick article they have there is Dinwiddie was able to come to terms with the NBA, removing the player option and finalizing a January 13th launch after months of delay. Sprung wrote, adding, "Dinwiddie is going to sell his securities-backed SD8 tokens, which can't be traded for a year, for 150,000 USD a piece to verified accredited investors under SEC Regulation D, Rule 506C." And that's pretty much the majority of this article, if you're interested. But either way, it's all part of the adoption, which we said soon enough everything would be tokenized. Also, we have China to adopt blockchain for governmental service centers. As per the recent report, the provincial government of Anul, China, is stepping up the game of blockchain technology. The agency is looking to adopt blockchain technology across governmental service centers. This report was published by Xinhua news agency Anui and states that the new move is intended to optimize the business environment within the province. It was reported that emerging technologies, including blockchain and artificial intelligence, AI, will be considered as the key solution to offer governmental services on a 24/7 basis. China is enthralling its pace towards the peaking point of blockchain technology. Notably, this comes in the wake of the country's President Xi Jinping's speech on emphasizing China to be a world leader in the blockchain spectrum. As for the recent report, the move is to digitize Anui's government infrastructure, which promotes a disciplined and transparent approach to the collection and sharing of government data and resources. The measures have promoted our province's relevant policies and practices to optimize the business environment to the rules and regulations, make it further systematic and standardized, to strengthen the authority and legal binding force, and specifically address the existing problems in the actual work of optimizing the business environment, reads the report. Besides, it was also announced that the Anui Securities Regulatory Commission is working to raise the awareness against financial scams. The motive, however, is to crack down on the illegal blockchain and cryptocurrency initiatives. Similarly, in December last year, the central government of the country released a set of guidelines urging the region to double down on emerging technologies, including cloud computing, artificial intelligence, and blockchain technology. Anui is certainly following the central government guidelines. In a nutshell, Anui's partaking in blockchain technology is remarkable. In mid-December 2019, the Anui Tea Industry Association reportedly partnered with the blockchain technology platform VeChain. With the partnership in place, around 670 Chinese companies from the tea industry could use the VeChain Thor blockchain. And as a VeChain investor, I love seeing news like this, and I'm sure many of you are VeChain investors as well. VeChain is one of the 2 approved in China blockchain cryptocurrencies. So China population, considering the global population, that is very significant and massive for VeChain partnerships. If you're new to VeChain, you might want to do research. We have a couple of videos on here. We'll probably add some more to update the new people. If you are an investor, then you're aware and very excited. We're going to finish off this video. It was a little bit long today, but I wanted to go through these updates. I had so much in my files. I needed to finish these. Some of these are a day or 2 old, but we had not put them on video, as we have different subscribers on Twitter, and then we do on YouTube, and not everyone is on both channels. So we try to keep them both on here, as much updates as we can, and everything we do on YouTube we try to share onto our Twitter. If you're new to this channel, we basically began from in the sense of like your standard news channel, goes through the articles, as much detail as possible. Our channel basically began with a conversation of at a request of, I would love to have a channel that I could work, I could go jogging, or I could be preoccupied and not have to look at my screen. If I chose to look at it later, then I could come back and review the video, or driving in my car during traffic, that I could hear and get as much information I could as if I were reading. That's basically, if you're new to this channel, how we were created and how we started. It all began for us. So when you hear, we try to give as much information as we can, so you don't have to come back and reread it. You're basically just getting it all for you. We will shorten some stories, but we will inform you as we do, so that you can come back if it's an interest to you and re-reference that in the description below, as we do include every link for further research at your own interests. Okay, finalizing today's video, we have the ex-VP at JP Morgan Chase ask if Iran and North Korea can use XRP without U.S. interference. Cryptocurrency expert, former Wall Street trader and vice president of JP Morgan Chase, N.Korea has questioned the centralized nature of Ripple and its digital currency XRP, pestering to know if it would be possible for embattled North Korea and Iran to make use of the remittance platform and its on-demand liquidity, the ODL, without the U.S. interfering. The financial analyst who dubbed XRP a scam coin had in the past criticized Ripple and its tokens for a number of reasons. He said Ripple claims XRP is decentralized and uncontrollable, but if Iran or North Korea made use of Ripple's XRP as a global currency and value transfer, just a mere call from the U.S. authorities to the CEO of Ripple, Brad Garlinghouse, will make the company prevent the two countries from making use of the asset. The recent situation between Iran and the United States must have been the basis of Tone's opinion. Vase made assertion to question XRP's level of centralization once again, and its ability as a centralized currency to help the two countries out of the sanction placed on them by the U.S. Then there, in this article, has a tweet by Tone Vase, and it shows the interview with Ripple CEO Brad Garlinghouse. Tone said Ripple claims their XRP scam coin is decentralized and uncontrollable, but if Iran and North Korea start using Ripple as a global currency and value transfer, all it will take is a phone call from the U.S. authorities to Garlinghouse. Tone responded to a viral interview video of the CEO of Ripple, Brad Garlinghouse, hosted by Julia Chatterley on CNN. Brad spoke elaborately about the price of Ripple's XRP. He said, Ripple, as the largest owner of XRP, is the most interested party in the success of XRP. Thus, despite accusations, dumping XRP on the network isn't something of our best interests. We're interested in a healthy, successful ecosystem, and so we would never do that. And we have taken steps to lock up most of the XRP we own in escrow. Essentially, we can't touch it, he stated. Brad claimed Ripple could not control the value of XRP, but the firm is interested in the broad adoption of XRP. Hence, its reason for investing into big firms and startups. Ripple can't control the price of XRP any more than whales can't control the price of Bitcoin. Nobody is in a position to manipulate XRP prices. And we're going to complete this segment off with that article today. So we hope that you enjoy the show. And for those of you that are here, thank you so much for your support. We love you guys and appreciate you. So we'll catch you in the next one.